Chapter 11, Advanced Risk and Capital Preservation. Section 3, Correlation. Correlation is the idea that some investments respond to the same market forces at the same time. If most of your holdings tend to fall together during a rate shock or recession scare, losses can stack up and the portfolio becomes more fragile. When assets react differently, they can offset each other and help preserve capital, which is why diversification depends on behavior, not just how many positions you own. Correlation measures how two assets move relative to each other, not whether either asset is good or bad. On the scale, +1 means they move together, 0 means there's no reliable pattern, and -1 means they move in opposite directions. Most real investments land somewhere between those extremes, which is what makes correlation useful when comparing how assets may behave together in a portfolio. The sign of correlation tells you direction. A value near +1 means two assets have tended to move together, while a negative value means they often move in opposite directions. The closer correlation is to 0, the weaker that relationship has been, and that matters for diversification because lower or negative correlation can help smooth returns and reduce volatility, while high positive correlation can increase concentration risk. Correlation matters because portfolio risk depends on how investments move together, not just how risky each one is by itself. When two volatile assets respond differently to market conditions, their ups and downs can partially cancel out, creating a combined portfolio with smoother returns. That is why diversification helps preserve capital. Low correlation can reduce overall volatility, and negative correlation may even offset some losses without automatically lowering expected return. A portfolio made up only of growth stocks rises and falls with the stock market, so its swings can be larger. When you combine growth stocks with long-term government bonds, you add assets that often respond to different market forces, which can make the overall path smoother. Bonds may help soften losses when stocks are weak, but they do not guarantee protection or prevent losses entirely. To analyze correlation, start with matching return data for both assets using the same time period and the same frequency, whether that's daily, weekly, or monthly. Then calculate Pearson's R and read where it falls on the scale. Near +1 means the assets tend to move together, near 0 means little relationship, and near -1 means they often move in opposite directions. When the goal is to reduce portfolio volatility, less correlated assets are usually more helpful, but it's important to recheck over time because correlations can drift. Correlation only tells you how investments tend to move relative to each other. A low correlation can help diversify a portfolio, but it does not mean the investment is safe, high quality, or attractively priced. You still need to check other risks, including credit strength, liquidity, and valuation. An asset can reduce portfolio co-movement and still be a poor investment on its own. Suppose you already own $50,000 in an S&P 500 index fund and want to add another $50,000 with less volatility. A technology ETF with a correlation of +0.85 would likely move with the same stock market forces, so it adds similar equity exposure rather than much diversification. A treasury bond ETF with a correlation of -0.3 is more likely to offset some of those swings, making it the stronger choice when capital preservation and smoother returns are the goal. Historical correlation is useful evidence, but it is not a promise about how assets will behave in the future. In calmer markets, investments may move differently and diversification can help, but during panics those relationships often tighten, and assets that usually offset each other may fall together. That is why correlation analysis has limits and should be reviewed regularly, especially with the risk that protection may weaken when you need it most. Correlation needs context. Common mistakes include assuming old relationships will keep holding, relying on too little data, or thinking low correlation automatically means an investment is safe when both assets can still fall together in a sell-off. It also helps to check what happens during stress periods, when correlations often rise, and to be careful with daily data for illiquid assets, because stale prices can distort the true relationship. Correlation helps you build a portfolio that doesn't move in lockstep, because it shows whether assets are likely to amplify each other's moves or help offset them. In practice, combining assets with low or negative correlation can reduce overall volatility, but the goal is not a perfect hedge. Treat correlation as a useful guide and keep reviewing it, because market stress can change relationships when you need diversification most.